When it comes to investors maximising their tax deductions, they often only take their own renovations into account. But what if I told you a previous owner's renovation could also be yours to claim? Hey everyone, Nathan Mai here for another video designed to help you become a better property investor. We get it, it makes sense. You make your renovations to your investment property and then claim them back on tax. So why should you even be eligible for more than that? Well, as it turns out, investors often qualify to claim on deductions on investment properties in Australia, even if they didn't complete the renovations to the property in the first place. Today, I'm running you through several things you need to know to claim a previous owner's renovations back on your investment property's tax return. So stay tuned. First of all, it's absolutely essential that you understand what you can claim. Ultimately, it comes down to the effects of the 2017 federal budget. Basically, depreciation laws have changed a lot, so you need to compare what impacts your entitlements. For example, if you purchased your property before the 2017 budget, you can make claims under the Division 43 and Division 40 of the Income Tax Assessment Act. But you'll need to do this by organising a property depreciation schedule through a quantity surveyor like us. Additionally, you'll need to know the cost and the date of the work that was completed. If you don't have this information handy, this is where a quantity surveyor can also help you fill in the gaps. On the other hand, if you purchase your investment property after the 2017 budget date, things aren't so simple to decipher. You will need to take into account just how much renovations was completed or if there was any done in the first place. This is because in the 2017 budget, the government included the term new residential premises to the whole new matter. Basically, this term refers to the GST Act. It applies to the newly built, substantially renovated or knocked down and rebuilt properties. If your investment property doesn't fall into the three categories mentioned, your depreciable assets probably won't be entitled to the deductions that you would have been entitled to if you purchased it before the 2017 budget. Don't forget, you're still entitled to claim 2.5% of costs associated with what's known as capital works improvements on the property. And you can do so for each year for 40 years from the date the upgrades were completed. The problem here is that you can only claim for the years that the property is rented out. So if you're not sure how much you're entitled to get back, have a quantity surveyor give you an estimate and back yourself with a tax depreciation schedule to be sure. To put it all into perspective, most homes that are more than 10 years old have had some work done to them, with bathrooms, the kitchen, flooring, and walls being the most common fix-ups. So if we were to break down the costs associated with these, you'd be looking at something like bathroom renovation costs up to around $15,000, kitchen renovation costs up to around $20,000, and the floor or wall renovation cost up to around $5,000. On a property that's 1 to 3 decades old, that's already a significant amount of money that you could be missing out on if you haven't had a quantity surveyor assess your property. By carrying out this assessment, you'll be able to determine what assets and capital works in your property are on the agenda to be thrown out or demolished, and whether you're entitled to assign a value to them and offset them as a capital loss. Ultimately, renovations on an investment property don't need to be taken out by you to be tax deductible. You could be sitting on a gold mine and not even know it. If you found this video helpful, don't forget to check out our YouTube channel and subscribe for more useful tips. And make sure you click on the bell icon so that you can get notified of the next video. Until next time.